Today, two banks produce their half-year results. This one you can get them at the Nairobi Security Exchange website. At the financial result, there was Family Bank, there's Absa Bank. Apparently, they have not yet published them on their website, but you can be able to get them here. So what I'm interested in is Family Bank. Why? It was listed the other day on 23rd. I want to see how it's performing. If you look at the profit after tax for Family Bank, it's gone up from a figure of, if you come down here, from a figure of this profit after tax, 2.2 billion to 3.7 billion. That is a whopping 61.8% increase in profit after tax. The other ratio that I want to check is their price earning ratio. Currently, Family Bank is trading at 33 bob per share. If we take that 33 bob and we divide with the earning per share, the earning per share for their half-year results is 2.23. Multiply that by 2 to get at least an annualized EPS. That is 4.46. Divide the 33, divide by 4.46, you get a figure of 7.4. What that means, once you buy Family Bank today at 33 bob, it will take 7.4 years for you to recover your investment. Or in other words, it means investors like you and me are paying about 7.4 shillings for every Kenya shilling one of annual earnings. The other thing that we need to look at is their return on equity, which we get from net income divided by shareholders' fund. Their net income is 3.7. Multiply by 2 to get annualized net income of around 7.4 billion. Divide by the shareholders' funds, which are here, which is around 33. Total shareholders' fund is at 3.2 billion. You are going to get an annualized return on equity of around 22.5%. That is a return of more than 20% is encouraging, and it shows that the bank is currently generating a strong return on shareholders' capital. The third ratio that I want us to look at is book value per share, or to find out, is this Family Bank trading at that 3 bob? Is it overvalued or undervalued? And how do we get the book value per share? We get the net asset or the shareholders' funds, which are 33.2 billion, the shareholders' fund, divided by the total shares outstanding as of today, which is 1.6 billion. 66 billion. You are going to get a book value per share of 19.98, and it's trading at 33 bob. So it is slightly overvalued. I wish it was trading at 18. Oh, that would be so attractive. Then we need to look at something that was of a concern when it was listed, the gross non-performing loans. You can remember it was at 18%, and if you compare with the industry standards, which is 15%, it was quite high. But unfortunately, their half-year results, they are still showing that they are not performing so well. If you look at gross non-performing loans, it has increased from 15.2 billion to 18.1 billion. That is a key risk to watch going forward. So they have increased with 15.1%, which is quite high. Dividend yield, they didn't declare any dividend. If you look down here, they didn't declare any dividend. The only dividend which is there, it's one for last year, which is 1.20. So we cannot be able to calculate the dividend yield. So maybe once they produce their annual audited statement, that time they are going to give us their dividend yield. In conclusion, at Kenya shillings 33, Family Bank is no longer cheap as it was when it was listed at 18 bob. But based on the latest numbers, the bank is still showing strong profit growth, good return on shareholders' equity, and a reasonable earning valuation. The biggest thing that one needs to watch going forward is whether the strong profits will continue growing and whether the bank is going to reduce its non-performing loans. Remember, good investment decisions are not based on the share price only. Look at the numbers behind the business. It's also important to compare its performance with its peers, Cooperative, ABSA, Equity, KCB. And as you have seen, banks, they are reporting different books. One has stronger profit growth, another one may have better dividends, another one may have a stronger balance sheet, like now Family Bank, its non-performing loans are deteriorating. And that's why with the upcoming ETF that will be listed in October, if you buy a piece of that, you'll be able to spread your exposure across them. And that means you are tapping on the strength of this one and the weaknesses of another one, and you neutralize everything and come up with one good investment package. So mtafute pesa. I'm still reminding you. Thank you.